Welcome out to Module 2, Step 2 of Tackle Trading 7-Step Guide to Trading. This is Coach Matt. It's a pleasure to be with you for our second go around here in the 7-Step Guide to Trading. Let's jump right into it in terms of reviewing what we covered in Step 1. We talked about starting at the top of the markets. We call this the top-down approach to the markets, where we analyze the market indexes to determine a bias to the market. We always want to be trading in the direction of the overall market. That's number one. Then we look at sectors and industries and individual companies. We talked about the differences between aggressive sectors and defensive sectors. Now let's get into step 2, which is to choose the appropriate trading strategy for the condition that you are analyzing in the actual financial markets, and specifically that of the S&P 500. The first thing we want to talk about is a broad topic called portfolio design. Now, what a portfolio is it's simply a collection of all investments that you have in stocks, bonds, currencies, and commodities, and even real estate that is owned by the individual. Now, in the financial world, we would consider this in some type of an account, like a 401k, a solo 401k, different variations of the 401k model, the IRAs, both SEP IRAs, Roth IRAs, traditional IRAs as well, but also your individual accounts that you can have, like margin accounts, currency accounts. Everything that you have in the financial world, we would consider that a portfolio. Now, everything is by design, including portfolios. So the questions that you kind of have are, what systems do you trade? What is your asset allocation per system? How much money do you want to put in per trade in that system, such as that is called position sizing? These are some of those questions that we're going to tackle here in Module 2. Now, in terms of a portfolio, I want to go just high level for a second. There are 3 different aspects to a portfolio. The first one is what we call cash flow systems. The second is what we refer to as growth-based systems, and the third is what we refer to as speculation systems. Now, your cash flow systems would be what we refer to as theta strategies. Covered calls, naked puts, bull put spreads, bear call spreads, those 2 are referred to as vertical credit spreads. If you combine the bull put and the bear call, we call that an iron condor. Calendar spreads and diagonal spreads, inverted butterflies, these are names of strategies that you will learn as you grow as an option trader and as a trader in general in theta strategies. Your growth-based strategies, and there are a lot of different ways to invest in the financial world. These are just a couple of them. First of all, just buying a stock that you like, that you want to own long term, that pays you a good dividend. Value investing, the old Warren Buffett school of value investing. Can Slim, the growth-based stocks, high valuations, growth, lots of growth in terms of that. Precious metals, investing in gold and silver. And then speculation trades are more aggressive in general, typically have lower position size, lower asset allocation. You want to be very conservative with how much money you allocate in speculation systems, such as long stock in swing trading, long call in swing trading, short stock in short-term trading, long put, bear puts, bear calls. Those are just a few of the examples. So now that we have an understanding of what a portfolio is and the 3 different segments of a portfolio, cash flow systems, growth systems, and speculation systems, let's talk about asset allocation. When it comes to asset allocation, that is the percentage of your portfolio that you allocate to different aspects of a portfolio. So if you put 40% in cash flow and 40% in growth and 10% in speculation, that leaves 10% in cash to hedge or to make new trades in that capacity. If you have 60% in growth and 20% in cash flow, obviously you could do a little bit more speculation. So as you grow as a trader and you learn more systems, your portfolio design is going to evolve the same way you evolve as any trader goes. Now, the second question you have as you're determining exactly what your asset allocation is what systems do you actually apply that to? Cash flow systems like the Tackle 25 versus cash flow condors, personal gold, credit spreads, inverted butterflies, all those different strategies I talked about just a moment ago. You as a trader have to determine which systems you want to actually allocate to the portfolio for cash flow or for growth or for speculation. And then the last question you have to determine is what is your position size per system. So for example, in the Tackle 25, there are 25 stocks that are great covered call stocks, but I don't want to invest in 25 companies. I want to invest in 5 or 6 or 7 companies. So let's paint a picture here as we're doing this position size. Let's say hypothetically we have $100,000 in the portfolio, and I've made the decision to allocate 60% of my portfolio to cash flow systems such as the Tackle 25, Personal Gold, and Cash Flow Condors. Those are all systems you can learn at Tackle Trading. Now, in terms of that, I need to determine what is my position size per system. So if I want to do 6 covered calls, for example, and I'm allocating 60% of my capital to the Tackle 25 cash flow systems like the covered call, I would allocate $10,000 per position. So your position size is a percentage of what you're allocating to a specific system. The same thing can be said about growth systems or speculation systems. So the first step is determining what your portfolio design is, what systems are you going to trade. The next step in terms of systems would be the percentage of allocation to specific systems. And then the last step would be to determine what your position size is per trade within a system, and that goes for cash flow, growth, or speculation. Now, in terms of choosing what to trade, there are 4 major tradable instruments. The first one is what we call the stock market or the equity market. We buy stock and we short stock in equities. The second market is what we call the commodity market, most likely traded in the futures market, but for every commodity out there, you can trade ETFs that track those commodities. For example, gold is /GC in the commodity market called the futures market, but it's GLD as an ETF. Same thing with silver /SI would be SLV as an ETF. So regardless if you understand how to trade the futures and commodity market, you can always trade commodities within the actual stock market. The third major market we trade in is the options market. Primarily speaking, in the options market, you have delta strategies, which are speculation, theta strategies, which are cash flow, and vega strategies, which are volatility. Now, for most new traders who are new to the options market, they start with something simple, buying a call instead of buying a stock, buying a put instead of shorting a stock, covered calls like the Tackle 25. Start with something extremely simple when it comes to the options market before you get into the intermediate or advanced strategies such as credit spreads, iron condors, and combination option strategies that advanced option traders really enjoy. And then the fourth major market is what is known as the currency market. Now, as a trader, I do enjoy the ability to trade all the major markets, and the beautiful thing is that the technical analysis in the stock market is no different than the commodity or the currency market, and the technical analysis in the stock market has nothing to do with the actual option, because that just might be the tradable strategy or instrument that we're applying to the stock, since options are a derivative product of the actual equities themselves. Now, in terms of the bullish option strategies, how to profit trading bullish conditions. First and foremost, you can always just go out there and buy equities such as long stock or exchange traded funds that are a basket of different stocks that track different areas, different sectors, different industries, different commodities, currencies that you can trade in the stock market. Next, options such as long calls, combination trades, spreads, calendar spreads, others, long futures, currencies, buying currencies, all of these things make money in a bullish condition. Now, next, profiting in sideways or neutral conditions can be tricky if you don't know how to trade in the options market, because trading in the stock market is what we call a directional market. You buy a stock, it goes up, you make money. It goes down, you lose money. You don't make money in neutrality. And so in neutrality, it's all about selling options, naked puts, covered calls, other types of strategies such as credit spreads, iron condors, buying and selling in the futures market using options in the futures market, and the same thing in the currencies, such as the carry trade, where you can profit off the different interest rates of different currencies. So there are ways to make money in sideways neutrality conditions, but most of those ways are dividend paying stocks, carry trades, and outside of the options market. But within the options market, there is a plethora of different strategies that you can employ in your portfolio to be very, very successful in a neutral sideways condition in the market. And then finally, but certainly not least, is the almighty bear, how to profit in bearish conditions. The type of strategies that profit in bearish conditions in the equity market is short stock or ETFs. Shorting stock is the sell of a borrowed security with the expectation that it is going to go down in price. In essence, you're borrowing the stock from your broker. You believe it's going to go down in price. You're going to sell it at a higher price. You're going to buy it back at a lower price. That's shorting stock. You can do the same thing with exchange traded funds. Now in the options market, you can buy a put option instead of shorting a stock. You can do different types of combination trades. You can short futures contracts. You can also short currency pairs as well. Now in terms of determining what strategy we want to employ, we got to go back to step one in determining what that market bias is. And if you remember in determining the market bias, the most important aspect is determining the trend and specifically the strength of the trend. In a bullish condition, a trend is established when you have a series of a higher high, higher low, higher high, higher low, higher high, higher low. This is a specifically repeating pattern in the financial world where we want to buy at support and sell at resistance. Now, determining the strength of the trend, which is all based on momentum, that will help you determine what your bias is in the +1, +2 to +3 capability. Now, in terms of the bearish downtrend, we have a series of lower highs and lower lows, lower highs and lower lows. And as that trend continues, the probability that the trend will stay intact is continuing to go down. What do we want to do? We want to short stock, buy put options, and employ those bearish strategies to match what this condition is. And just as a reminder, Jesse Livermore said it better than I could. A prudent trader never argues with the tape. That's the market. Markets are never wrong. Opinions are. Check your opinion. Check your belief system when it comes to the financial world. It's not about what you think. It's not about what you think you know. It's about what you see on that chart. The chart tells the truth of the markets. Now, in terms of selecting the strategy, for example, again, coming back to step one, remember we have a bias of bullish. We have categories of bullish behavior. +1 is slightly bullish. +2 is bullish. +3 is very bullish. On the downside, you have -1, -2, and -3. -1, slightly bearish. -2, bearish. -3, very bearish. And then in your zero, that is where you have your cash flow neutrality type trades that work really, really, really well. Now, in determining what strategy to employ as you look at your bias, we have put together a very helpful little playbook that can help you match your bias to the appropriate strategy. So if you're very bearish in the market, buying puts, back ratio spread, short stock, that makes a lot of sense. By the way, you can do those same thing in -2 as well. But in -2, you could also do some put debit spreads such as the bear put spread. You can also look at naked calls, -1 bias. You're looking at credit spreads, butterfly type trades. In your neutrality, you have your iron condors, your credit spread, your calendar spread, your butterflies, your double diagonals. And I know a lot of that doesn't make a lot of sense to those of you who are very new to the market. But as you grow as an investor, as you grow as a trader, as you learn more strategies, systems, and techniques, this will be extremely helpful for you to determine strategy for bias. And then have your +1, +2, +3, where you're buying stock and buying calls in +2 or 3, doing some more aggressive strategies like ratios or risk reversals when you're very bullish. In your +1, though, you're looking at bull put spreads, bull call spreads. You're looking at covered calls for both +1 and +2. So you can do a lot of different things. So let me give you a couple of different examples. If I'm +1 on a stock, I know I can do vertical credits, vertical debits, and covered calls and naked puts. That's what I know I can do. That's my strategies. If I'm positive 2, I can do long call, long stock. I can do vertical debit trades. Those are the strategies that I like to employ. When I'm positive 3, I want to go pop some call options and be aggressive. I want to be aggressive in that environment. Same thing on the downside. Now, as you can see, this is not a recommendation. It is just a playbook that you can employ, but a very helpful playbook in and of itself. Now, like we talked about in session 1, Tackle does have an ecosystem that helps you analyze, apply, and understand what's happening on a daily and a weekly basis. First and foremost, for those delta strategies, those speculation strategies, you have every single week, you have your scouting reports. For your other delta strategies, we analyze those every Tuesday in the Coaches Show. For your cash flow strategies, we analyze those every day, every Thursday in the Cash Flow Club. For your cash flow strategies such as systems, you have cash flow condors. For delta hedging and speculation in bearish conditions, we have Bear Market Survival Guide. And for your covered calls, you have your great Tackle 25 covered call systems as well. Now, if you've been enjoying the 7-step guide so far and you've been learning from the 7-step guide and you want to continue to grow as a trader within our community, you can sign up for a pro plan at Tackle Trading, and we're going to give you 15 days free on us, and I'll tell you how to do that here in just 1 second. But what do you get as a pro member? Number one, you get all content for rookie and varsity. You get access to all of our blogs, our scatter reports, the stock report, options report, commodity report, forex report. You get access to the daily traders lounge, coaches shows, cash flow clubs, mind of a trader, and then you also get access to the Tackle 100 series, which are video modules that will help you understand technical analysis, option trading, futures trading, and then system development 101 as well. And you can get all of that 15 days free on us by visiting bit.ly/join-tackle-pro. Once again, that's bit.ly/join-tackle-pro. Sign up for 15 days. You get it on us. And if you don't like it, no harm, no foul. On to step 3. In the next module, we're going to find and analyze potential trades. We're going to set the trades. We're going to set up the trades. Stop loss, entry, target. This is Coach Matt for Tackle Trading. Hope you enjoyed the module.